The stock market is going wild, and the number one biggest risk has already begun to take its toll. You came here for the truth, so let me unveil that for you. In today's video, we are going to look at companies like Apple that have already started to see what could be the biggest risk to these big tech stocks. I'm going to explain why, and I'm going to look at what's going on with the gold price hitting all-time record highs. I'm going to show you this. Even if you're not a big time investor, you have to understand the big changes that are going on here and now. Let's begin. First things first, the fear and greed index. Yes, that has come back a lot. I mean, it's funny how quickly it can come back. And when it goes crazy and everybody's investing in all these silly things, it barely finds its way into the extreme greed category. Just a little thing to look at. It is broken down into multiple things. Market momentum, so based on its moving average, like how quickly things have been going. It's the stock price strength. You can go through all of these. Links are in the description, but you can just go to a search engine and type in, fear and greed index, and there are some like this, the breadth and things. We are looking at a issue that of course has been going on for quite a while. Investors who just book profits in one of the strongest first quarters of the S&P 500 index in decades are preparing for what comes next, whether that stock's climbing higher or crashing back to earth. Let's be clear about something. The rise in stocks that we have seen over the last while has been incredible. There's no question about it. Back in September of 2022, if you were here on this channel, I told everybody where it looked like it would be. And at that time, I didn't say that, okay, this is going to be higher forevermore. But I positioned it as it looks like this is the bottom, at least near term. This is where we are. So I posted that twice on the community section of the channel. I also included that in several videos along that period of time. That was September and then into October of 2022. Of course, that was the bottom, and we've been going up ever since. The stock market has really defied basically everybody's expectations, even some of the biggest bulls. And so we have seen it all along during a time in which we were expecting recession. We were expecting all these things. Economists were putting that out there, and we were having to say, okay, well, everyone says it's a recession. So do we then have the contrarian view in this case? Well, the most expected recession ever never got officially determined and classified. So we'll see what will happen in the next year. People have been saying, yeah, it's actually going to happen into next year. We can hear a lot of the deflation talk and things. I'm not so sure about that. In my group, the Finance Friday group, we talk a lot about this, but it doesn't seem like a lot of that will come along when you print trillions of dollars, when you tell people that they have nothing to worry about ever, ever, ever. Asset prices can stay elevated even with a truly weak economy, okay? And so if we have a stronger economy or a moderate economy, and then you dump all this cash in on top of that. At the same time, you have a lot of places around the world that hadn't been doing very well. In the example of China, the money has to flow somewhere, and the biggest beneficiary of all of that, of course, is stocks being in the US primarily. With the stock market sitting at an all-time high as the second quarter begins, this tells for what traders are thinking lie in the options market. Demand for put options that pay off if there's a minor correction is around the lowest in years. Meanwhile, traders are quietly picking up tail risk hedges, instruments that do little if there's a slight downdraft, but offer protection if stocks swing wildly. So now they're looking for some place to make some cash. That's what they're doing. They're saying, okay, I'm done with the trade of the tech trade. I've put so much into that. Now what's going to happen? It's been too hot. We got to see a reversal. Maybe I should bet on that. That's what people are doing right now. There's a number of tail risks that you can point to, and the market has moved a lot. So I'm not surprised to see demand for tail hedges. I'm more surprised to see the lack of demand for basic hedges, because people have learned that the stock market just keeps going up and we have nothing to worry about ever. And so they're tired of that. They don't want to lose money on this. So they're just investing in the mega cap stocks, just a handful, small handful of stocks, and that's carrying the market upward. That's how it works. So you get the benefit if you own those particular stocks or you own the broad index, because either way, you're becoming a beneficiary in this regard. So I want to talk about this though. Fed officials still expect rate cuts this year, but not anytime soon. So we have seen yields responding to that, the bond market responding to that. It is, of course, extremely important what the Federal Reserve does, not even just directly, but also indirectly. Okay, I need to make that clear. Magnificent Seven is back to the greater than 30% of the S&P 500's market cap. Okay, your top 7 stocks, which really, you start to narrow that down. It's actually just a couple, but the S&P 500, okay, is 30%, greater than 30% of that is just a handful of stocks. That is not a good sign. Now, as the years have gone on, this has been the case. Like you can see from 2013 up until now, it's just been rising, but that's not a healthy thing. All right. So people generally, I think for most people, what they should be doing if they want to invest in stocks is to invest in the broad market, because whether or not, like depending on which one you're going to buy into, you're going to be okay, because that market will just go up and you don't have to worry about, is it the Magnificent Six? Is it the Magnificent Five? Simply investing broadly will be good for most, right? It's better than a mutual fund. It's better than all these other things. Gold prices hit another record high after fresh U.S. data spurs Fed cut expectations. That's right. Well, obviously, during this period of time, we have seen an increase in what people believe is, this demand for the safe haven. Of course, they're buying paper gold, but anyway, you could look at the time of this recording, gold just shy of 2,300. All right, now silver has moved up over $26. It's been there before, as you know. It's that metal's been depressed quite a bit over the last several years. It has been much higher historically as well. So that's a different story. But when we're looking at gold, what is it? It's the expectation of the devaluation of the currency. That's it. That's what that is all about. Safe haven, looking for a place to park their cash. Tech has been the least regulated sector of all U.S. sectors. This, my friends, is the biggest piece of information that you will find in the financial world today. Okay, you got to look. We're going to look at the chart again in a second here, and I want you to understand, I've talked about this for a long period of time. Okay, because I've seen these numbers before. Now these are updated. You look at all these different industries, look at it across the board. Financial industry, now think about what happened during the financial crisis. Look at what happened during 2000. These events here, they put in the bill after. They say, okay, we're going to make sure we're going to protect them. We're going to institute this law. And what do later? They roll it back. Okay. But even considering that, the financial institutions are much more regulated than the tech industry. And what happened to the financial industry over the last many years? The more regulations they put in, the prices of those stocks just cannot perform the way they did before. And that's potentially what could be happening here with the tech industry. Then think about artificial intelligence as well. So this is the number one. I've said this 1,000 times before. For those who are on this channel, you've heard me say it. The number one factor here that could impact tech stocks is regulation. Keep that in mind. Just look at it. My goodness. Of course, manufacturing, you want to have a lot of, scrutiny. If you're going to make, let's say, a supplement or something, or some sort of chemical agent that you would be using, you want there to be safety regulations and all these things put into place. finance. You don't want to put your money in the bank and then that bank could simply just walk away with your money. There's all kinds of different regulations that are put in place. Sure, great. Transportation, we don't want wheels falling off vehicles, like all these different things. I get it. I understand. But when it comes to technology, when it comes to the e-commerce, the Amazons, all these things, the regulation is non-existent. And now we have artificial intelligence on top of this, which has no regulation. So this is the one, if it starts to come through. Now, they're paying more than any other to lobby the government to make sure this doesn't happen. But they still might force it through. If enough people are complaining about it, maybe. Now, this was from a little while ago, but I wanted to include it because it is very relevant. Apple loses $113 billion in value after regulators close in. So many different reasons. It's just one company, of course, but this is what you need to realize that, yeah, it does have an impact. Europe, of course, in the EU, they're always trying to clamp down on the different companies for one reason or another. Some of it is certainly good, like they did a lot to ban GMOs and all these different things. So that in that respect, very good. We'll see what happens in this one. Sometimes it just really overcomplicates things and actually makes it worse for the small businesses that operate rather than the big businesses. So we'll see what comes out of this. But, you know, they try to slap Apple, they try to slap Amazon, they just keep growing bigger. If they separate, like for instance, if we have a circumstance where Amazon has to separate, the sum, what is the saying? The sum is greater than the parts. But anyway, basically what we can have here is a case where they split up AWS from, you know, the Amazon e-commerce side. They say, no, you got to be two separate companies. Well, now you got two different ticker symbols, and maybe both become, you know, very investable, and maybe they actually grow to be much bigger than they were before. That is a very real possibility. Trying to split them up doesn't necessarily do anything, you know, to help people anyway. Reddit insiders have been selling the stock after the IPO. Look at this. The CEO sold shares, $16 million worth. The CTO, $6 million, and the COO, $16 million. Okay? They get out. They get out while people get in. Who benefits the most? Ah, that's right. The top of the top. And in this case here, the article is just saying the wealth of the 1% just hit a record $44 trillion. Those at the top will always continue to win. And everybody else is simply just a little fish in this very big pond. All right. If you want to know all the details, you want to be able to join the Finance Friday group, I would highly recommend you do so, because in there I get into this stuff for over 2 hours every single Friday. I want you to join. There's a link in the description. Yeah, you might have heard me talk about this before. Link in the description, but actually go there, actually click on it, and you could see it for yourself why this is more beneficial than all the YouTube videos and everything else. People get more information in there than you will get anywhere you can. Okay, if you want to find out about that, click the link at the top of the description, and don't forget to hit that thumbs up button on the way out. That's how you support this channel. Okay, just hit that thumbs up button, and as always, I'll see you tomorrow. Take care.